guys, Dave Keller here with StockCharts.com. Thanks so much for joining me for this special year-end 2022 series called The Top 5 Charts of 2022. Yesterday on day one, we talked about the S&P 500, particularly using Fibonacci analysis from the March 2020 low to the January 2022 high. What a great way of making sense structurally of this bearish phase that we experienced in 2022 and some key levels to pay attention to, I think, going forward in 2023. Today, we get to share with you chart number 2, which is interest rates. I was interviewed at the beginning of 2022 in a Market Outlook webcast, first week in January, and I was asked, what is the chart, right? What's the one chart investors should be watching in 2022 besides the S&P 500? My answer was not this exact chart, but it was a riff off of this chart, which is basically $TNX on the StockCharts platform, which is the 10-year Treasury yield. The reason why I thought that was so important is because I knew, at the end of 2021, it was all about recognizing, I feel that 2021 was a liquidity-driven bull market, meaning the Fed, as in an attempt to, grow the economy and really have the economy survive and thrive during a challenging, pandemic period. 2021 was about adding liquidity, injecting liquidity in the system to continue to boost risk assets and empower consumers to spend and grow the economy through a tough period. Toward the end of 2021, we sort of had this sense that things were okay, right? That things were going to get better. We're wearing masks and stuff, but the world's not going to end as far as we can tell, right? I think we can handle this and we can survive, and we think the economy is going to be okay. And there have been little mini booms and busts all along the way there over that previous almost 2 years since the 2020 low. But in late 2021, the Fed started talking about raising rates. If you remember that period, right? Fourth quarter of 2021, it wasn't we are going to raise rates. It was at some point we're going to talk about raising rates. But the Fed meetings were more just reiterating keeping rates very low and saying at some point we're going to talk about it. Then in the fourth quarter, it was actually talking about it and saying, yeah, we're going to start to raise rates probably next year. And it was all about how that might impact the market, right? What that might actually do. My conclusion, thinking of what that would likely do, is number one, that probably means interest rates are going higher. And number two, that probably means it's not a good scenario for growth stocks because growth stocks tend to do much better in falling rate environments or low rate environments than in rising rate environments. And you'll see that from the chart here in a minute as we go through it. Through the course of 2022, I think it's played out very well. When you think about leadership, whether or not you don't need to know what stocks are doing well at a given point. All you need to do is look at the 10-year Treasury yield, because when rates are going higher, value stocks tended to do better. When rates were going lower, growth stocks tend to do poorly. Let's look at the chart and you can see what I mean here. So left half is 2021. I have, just the 10-year yield at top. Second series down is the relative performance of value versus growth. And I'm using two ETFs, the Russell 1000 Value ETF, which is ticker IWD, and the Russell 1000 Growth ETF, which is ticker IWF. So when this line is going up, value stocks are outperforming growth stocks. When the line is going down, growth stocks are outperforming value, or value is underperforming growth. We'll get to this thing in the bottom in a little bit. This is the shape of the yield curve. So you can look at the shape of the yield curve a number of different ways. The way I've most commonly done it is just done 2s versus 10s. 10-year yield minus 2-year yield. And you can do that on stock charts using a simple mathematical expression, $UST 10Y minus $UST 2Y. So that's basically saying the rate on the 10-year bond minus the rate on the 2-year note. And that turns it into this purple series at the bottom. So let's start at the top and just look at the 10-year yield and what happened, right? 2021, essentially, rates were relatively stable. They tended to gravitate around the 1.5% level for the 10-year. We sort of overshot it up to 170. We undershot it down to we'll call it 120. But in the end, we ended the year right around 150. It was pretty much the median of the 10-year yield for the last 8 or 9 months. Look at how things changed in 2021. That's going to be a constant thing with probably all 5 of these charts of the top 5 charts of 2022, because I think they tell the story about this change of character in the market, how 2021 to 2022 was like flipping a switch from one type of market to another. We went from a low rate environment to a rising rate environment, because even though rates were higher at the end of 2021 than they were at the end of 2020, they weren't that much higher. Now, looking back, it felt like they were a lot higher, but now you can see that was nothing, right? That was nothing compared to what we've experienced in 2022, because the Fed raising rates has caused the entire yield curve structurally to change quite a bit. Look at the shape of this performance, and we can see that there's a couple different steps here, right? Overall, you have the first 6 months of the year where the 10-year yield is going higher from mid-June to early August, which is when the market bottomed out in June, then rallied to test the 200-day for the S&P 500 in August. That saw rates coming down. Then you saw another upswing in rates. This is when we broke above the 2018 high, which is here around 325. We also got above the June high here around 350. We broke above that. And the question here was, like, where could we go? And I remember being asked, how high could rates go? And people were asking, could we go to 2% or 250? And it's so funny how, what a quaint question here, right? In late 2022 to think about it. But again, it's just, we hadn't seen those levels in so long. So people tend to avoid and not want to entertain mentally the idea of hitting some of these key levels in the future. So having said that, once we got to 425, we once again rolled over. And this is when the market bottomed out in October. This is when the dollar index finally rolled over after having a string of just a consistent uptrend for the first 3 quarters of the year. And the fourth quarter saw rates coming down, saw the dollar weakening, and saw risk assets rally. And that's when the S&P once again rallied to test its 200-day moving average. Bond prices, of course, going up as well. Now, compare this top series to the series in blue, which is the relative strength of value versus growth. And you can see why I think this was such an important chart to track in 2022. Rising rates are better for value stocks. Falling rates are better for growth stocks. Now, why is that the case? To summarize it, I would say a couple different things to think about. Well, particular for the financial sector, rising rates tend to be good because it usually is implying that the yield curve is steepening, but not always the case, which has been the case in 2022. 10-year yields went up, and the rate, the key curve was actually flattening and inverting through the course of this year, of 2022. So not a great example, but generally speaking, you think of higher rates as probably being better for banks if the low end of the curve is staying relatively stable. Financial stocks did okay at times, but by the end of the year, we're really struggling, kind of limping into the new year, to be honest with you. Thinking of it from the growth side probably makes a little more sense. And this is what I would say, right? For growth stocks, your general idea is you are buying growth potential, right? You're buying the potential of these companies to grow earnings. And when rates go higher, those future cash flows, the future earnings that you're getting from the company are just less attractive because the interest rate environment is higher, right? So you're getting less benefit from the future earnings potential as opposed to if we started at a lower level. So lower rates tend to be better for growth stocks because their future earnings have more value today, if that makes sense, right? And flip that over, and that's why it's not as good for value stocks, because on a relative basis, because growth is just such a better bet when you see rates relatively lower. That's sort of the theoretical reason as to why it makes sense. But again, the charts tell the story, I think, very, very well. And you can look, there's a number of phases of higher rates, stronger value, falling rates, stronger growth, higher rates, stronger value. The November, December period, maybe the last 6 to 8 weeks of the year, not as significant, right? You can see how value clearly underperformed growth in June and July, but not as dramatically here in November, December. They sort of were still moving in lockstep. However, I think that was a key way of understanding the environment, particularly leadership, and just recognizing this line going up, recognizing how things like energy, materials, industrials were good bets early on in the year. I think was sort of the play, and just being long value and short growth, you would have had an incredible year, even with all the uncertainty, all the choppiness. It would have been just a fantastic 2022. Owning energy flat out, but doing a relative bet of long value, short growth was certainly the way to go. Now, the bottom series, and the reason why this is an important chart beyond what we've said so far is that bottom series, which is really looking at the shape of the yield curve. Here we're looking at, again, the difference between the 10-year yield and the 2-year yield. Now, just to digress a moment, what this chart is basically trying to do is capture the dynamic yield curve, capture the shape of the yield curve. On stock charts, if you go to charts and tools, on the right column, you'll see this thing called the dynamic yield curve, which is a fantastic visualization. It's a simple visualization, but a powerful one. You're seeing the entire yield curve here on the left. So we're looking basically at the 10-year point when we're doing $ TNX. That spread at the bottom, 2s versus 10s, is basically looking at the 10-year yield minus the 2-year yield. But what we could also do is look at the entire yield curve and look at the spread. And if you basically look at this over time, so start at the COVID low, you can see that the yield curve sort of had a natural steepness to it, which is normal, right? In general, it makes sense that the longer the duration, the higher the rate, because basically you need to be compensated for holding that debt longer, right? Is the general way of thinking about it. And this is how banks in general make money, is by lending at the short end of this, and then, borrowing at the short end of this and lending out lending out to consumers at the long end, right? So this is where they're borrowing from, other banks, from the Fed, whoever, and then the long end is where they're paying out, where you're paying back your mortgage or your car loan or business loan or whatever it is. As we go on, you can see how this naturally steep yield curve started to get into problems. And when we get into 2022, look at how the entire curve is popping up. And then we get this inversion. And now here in December, you can see this downward sloping yield curve. That is one of the best indicators of a recession, right? And if you look back over time, inverted yield curves have been a great predictor of recession. Now, not all inversions have led to recessions, but pretty much every recession has had an inverted yield curve beforehand. So just similar to the Hindenburg omen, which is a common way of using breadth indicators to anticipate a potential move lower in stocks or a potential bear market phase, the inverted yield curve has been a great indication of weakness and economic weakness and a high likelihood of a recession. So why does that matter if we're in a recession or not? Besides just the fact that we're labeling things a certain way, the reality is that when a market is in a recession, when the economy is in recession, the bear markets that are related to those in the equity markets tend to last longer in terms of their time duration, and they tend to be deeper in terms of their price deterioration. So whether or not we're in a recession can actually be pretty important when you look at the average bear market experience in a non-recessionary bear market versus a recessionary bear market. I think that might be one of the key questions going into next year, is whether or not that is a recessionary period, whether or not this is a recession. And if so, that just tells you to expect a longer, more drawn out bear market experience. So why is this important? Well, here we can see this, the inversion of the yield curve. The line going down, the spread tightening between the two, is showing you that the yield curve is not steepening, it's flattening. And then when it goes below zero, which is this line here you can see on the y-axis, that's when we become inverted here over the summer and have gotten more and more inverted going forward. Going into new year, one of the most concerning signs that I see about the overall equity environment and the likelihood of a sustained bear market phase, going back to our previous, chart number 1 of the 5 top charts of 2022, which was looking at the S&P 500 and the potential of S&P 3200 as a downside objective. Charts like this tell me that as a very reachable, very possible goal. Now, how is that the case? Well, besides just the fact that it's a recession, it's the idea that if rates continue to go higher, which I think they will, as the Fed raises the lower end, most likely you see a return to an uptrend in rates. And if that happens, that means bonds prices are coming down. Most likely equity prices are coming down, but it's also about the leadership. This also means that value stocks would probably be outperforming growth stocks. And here's the problem. Our benchmarks are very growth-oriented benchmarks, right? Look at the S&P 500. Look how big of a weight the FANG stocks are. Even though they've come down quite a lot in value in 2022, they're still significant weights in the benchmarks. And so those sectors, technology, consumer discretionary, communication services, are big weighted sectors in the S&P 500. So those big mega cap tech and consumer names struggling means it's going to be very difficult for our benchmarks to do well. Part of the story in 2022 has been the fact that even when the S&P has been in a downtrend, certain areas of the market, like energy in the first half of the year, like industrials earlier in 2022, like materials in the third into the fourth quarter, all have outperformed beautifully, even though the major averages have been struggling. that is an environment we could certainly continue to see, where it's more of an opportunistic equity experience, where you're not just going full on risk on into equities. You're being more opportunistic and you're looking for the charts and the themes that are working. And I would argue that if this chart continues the trend that we saw in 2022, it's value over growth. It means highly likely that we have a recessionary period, which means value stocks are probably in defensive names, defensive areas of the market are probably going to be the places to be on a relative basis. Now, the opposite side, and the reason why they think this is not just a key chart for 2022, but an important chart to watch going forward, is if rates would continue to go lower. On this chart, the 200-day moving average is just below the 2018 high, around 320. 325 is a key level there. The 200-day moving average is around 314 or so on the 10-year. If we hold that, as we pull back in the first, if we would continue to pull back in the first quarter, that could be a key level of support. So watching to see if that holds or if that might break, I think that'll tell you a lot of what you need to know about leadership themes and potential leadership themes going forward. So there you go. The second of the top 5 charts of 2022, the 10-year interest rate, $TNX. And in this case, we're looking at the 10-year yield, also the relative strength of value over growth, and finally the shape of the yield curve by looking at the spread between the 10-year Treasury yield and the 2-year Treasury yield. I hope you're enjoying this run through the top 5 charts of 2022. Stay tuned through the remainder of this week because we're going to get to numbers 3 through 5. All 5 of these, I would argue, are valuable charts that highlight really the potential of using stock charts to understand the big picture environment and hopefully empower you to make better decisions in your own portfolios. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe, be well, have a fantastic holiday season. We'll see you again live in the new year. Bye now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.